Hello everyone, welcome back to Accounting 429 Financial Statement Analysis course. In this lecture we are going to look at chapter 4 of your textbook, which focuses on understanding the income statements. We discussed in earlier lectures the importance of income statements as one of the sources of information that a financial analyst usually depends on to try to understand a company's performance. So let's move on to the following slide, where we're going to look at the learning objectives that we are going to focus on for this chapter. This chapter is a little bit big. It's going to take us about 3 weeks to finish, so please bear with me. But even though it's going to take a while to finish, you need to also understand that this is a very important topic in any financial analysis course, and due to its high importance, it's going to take us a little bit more than usual to cover. If you refer back to your syllabus, you will notice that topics covered in chapter 4 are covered over 3 different units and 3 weeks. In this chapter, we're mainly going to focus on income statement components and format. So we're going to take a look at that, try to understand how income statements usually presented. We are going to look at some accounting issues that relate to income statements. Then we'll focus on revenue recognition and expense recognition. Okay. We are going to skip earnings per share. We're not going to focus on this part and jump straight into income statement analysis and look at some of the ratios that relate to analyzing an income statement. And finally, we'll look at a comprehensive income. Okay, we'll wrap it up with a summary and do some problems. Now, taking a closer look at the components of an income statement, you might remember from our previous discussions that the main 3 components of an income statement are revenues, expenses, and net income. So it is mainly built around the formula, the basic formula that you have probably studied in your accounting courses, that revenues minus expenses equals net income. Okay. The income statement is also sometimes called the statement of earnings or the statement of operations. It is also called profit and loss statement. So looking at the first component, which is revenue generally refers to the amounts charged for the delivery of goods or services from the business to customers. So it naturally occurs due to the regular activities of a business. In case of a service business, let's say a business that provides cleaning services, for example, their revenue would be generated from all the cleanings that they perform to their customers. The term sales is also sometimes used instead of revenue, normally for businesses that sell goods and products. So your typical retailers or supermarkets and businesses in that field, normally they would use the term sales instead of revenue. Okay. Sales is sometimes understood to refer to the sale of goods, whereas revenue can include the sale of goods or services. However, the terms are often used interchangeably. Okay. In some countries, such as the United Kingdom and South Africa, turnover may be used in place of revenue. Okay, so you could see revenue or you could see the term sales, or you could see turnover, and these three terms basically refer to the same thing. Expenses, on the other hand, reflect outflows, depletions of assets, and incurrences of liabilities in the course of the activities of the business. Uh, Net income also includes gains and losses, which are increases and decreases in the economic benefits of the business, uh, which may or may not arise in the ordinary activities of the business. Okay. For example, when a manufacturing company sells its products, these transactions are reported as revenue, and the costs incurred to generate these revenues are expenses and are presented separately. However, if a manufacturing company sells surplus land that is not needed, the transaction is reported as a gain or a loss. The amount of the gain or loss is the uh, difference between the carrying value of the land and the price at which the land was sold. It is also worth noting that the definition of income encompasses both revenue and gains, and the definition of expenses encompasses both expenses that arise in the ordinary activities of the business and losses. Thus, the net income, profit, or loss can be defined as income minus expenses, or equivalently revenue plus other income plus gains minus expenses, or equivalently also revenue plus other income plus gains minus expenses in the ordinary activities of the business, minus any other expenses and minus any losses. At the bottom of the income statement, companies report net income. Companies may use other terms such as net earnings or profit or loss, so these different terms also refer to the same thing. Where applicable, companies present another item below net income, information about how much of that net income is attributable to the company itself, and how much of that income is attributable to minority interests or non-controlling interests. Companies consolidate subsidiaries over which they have control. Consolidation means that they include all of the revenues and expenses of the subsidiaries, even if they own less than 100%. And we've kind of brushed upon that specific point in the previous lecture. Okay, when we looked at an example of a consolidated income statement. Minority interest represents the portion of income that belongs to minority shareholders of the consolidated subsidiaries, as opposed to the parent company itself. Okay, so this is basically what you as an analyst would expect to see in an income statement, and a brief explanation of the different components that you might find in an income statement and what they actually mean for you as an analyst. For you as an analyst, looking at an income statement, you're not only looking at the net income figure, because in addition to presenting the net income statements also present items including subtotals that are significant to the users of financial statements. One subtotal often shown in an income statement is gross profit or gross margin, and that is revenue less cost of sales. Okay, so when an income statement shows a gross profit subtotal, it is said to use a multi-step format rather than a single-step format. Okay, so that is the difference between a single-step format income statement and a multi-step format income statement. Another important subtotal that may be shown on the income statement is operating profit, or synonymously known as operating income. Operating profit results from deducting operating expenses such as selling, general administrative and research and development expenses from the gross profit. Operating profit reflects a company's profits on its usual business activities before deducting taxes, and for non-financial companies before deducting interest expense. For financial companies, interest expense would be included in operating expenses and subtracted in arriving at the operating profit because it relates to the activity or to the operating activity for such companies. For some companies composed of a number of separate business segments, operating profits can be useful in evaluating the performance of the individual business segments because interest and tax expenses may be more relevant at the level of the overall company rather than an individual segment level. So the specific calculations of gross profit and operating profit may vary by company, and a reader of a financial statement can consult the notes to these statements to identify significant variations across companies. Operating profit is sometimes referred to as EBIT, EBIT, which basically stands for earnings before interest and taxes. And this is a very important figure for you to look at as an analyst. However, operating profit and EBIT are not necessarily the same because interest and taxes do not represent the only differences between earnings, which are net income or net earnings, and the operating income. Expenses may be grouped and reported in different formats subject to some specific requirements. So some of the items are specified by IFRS, but other items are not specified. Certain items such as revenue, finance costs, and tax expense are required to be presented separately on the face of the income statement. And the IFRS additionally requires that line items, headings, and subtotals relevant to understanding the entity's financial performance should be presented even if not specified. Expenses may be grouped together either by their nature or by function. So grouping together expenses such as depreciation on manufacturing equipment and depreciation on administrative facilities into a single line item called depreciation is an example of a grouping by nature of the expense. An example of grouping by function, on the other hand, sometimes referred to as the cost of sales method, would be grouping together expenses into a category such as cost of goods sold, which usually are abbreviated to COGS, which may include labor and material costs, depreciation, some salaries, for example for the salespeople, and other direct sales related expenses. Now here is a first example we're going to look at. This example is for Colgate's Colgate-Palmolive company. I'm pretty sure you all know this company, maybe even use some of their products like Colgate's toothpaste and things like that. So here is an income statement as presented by Colgate's Palmolive company. This one is for the year 2011. Okay, the first thing you might want to look at is the denomination. So they Colgate income statement is denominated in millions of US dollars, and then you'll jump straight into looking at the top line of Colgate's income statement. You'll see that they are showing their net sales for the year. Colgate's income statement shows gross profit, okay, i.e. net sales less cost of sales of 9.6 billion, exactly 900 or 9 billion and 590 million in 2011. When an income statement shows a gross profit subtotal, it is said to use a multi-step format like we just discussed in the previous slide. Colgate's income statement also shows operating profit, i.e. net sales less cost of sales and all other operating expenses of 3.8 billion. This was for 2011. Colgate include operating items other than um, selling general and administrative expenses in a single line labeled other income or expense. Okay, the 9 million in 2011 means that Colgate had other operating income of 9 million in 2011 compared with other operating expense of 301 million and 111 million in 2010 and 2009 respectively. The footnotes of the to the financial statements shown on subsequent slides provide additional information about each of these line items. Below operating profit, Colgate shows interest expense of 52 million for 2011. The net means that interest expense is presented net of interest income and interest capitalized. After deducting interest, Colgate's income statement shows pre-tax profit or income before income taxes of 3,789 million in 2011. After income taxes of 1,235 million, Colgate's consolidated net income is 2,554 million. As noted earlier, where applicable, companies present another item below net income, information about how much of that net income is attributable to the company itself and how much of that income is attributable to minority interest or non-controlling interest. For Colgate, 123 million of the consolidated net income is attributable to non-controlling interest and 2,431 million is attributed to Colgate itself. Finally, the income statement shows earnings per share, EPS, both basic and diluted. There's a detailed discussion of earnings per share in this chapter in your textbook. However, for us, we're not gonna focus much on that. You just need to understand that EPS stands for earnings per share. Okay, and we'll look at that briefly in following slides, but we're not gonna get into all the details explained in your textbook. Here we have a second income statement example. This one is for L'Oreal Group, a European company that sells beauty products. I'm pretty sure you guys know that company. Okay. The first thing you notice is that their income statement is denominated in millions of euros, being a European company. The top line of L'Oreal's income statement shows net sales. L'Oreal's income statement shows expenses, cost of sales basically, as a negative number. Their income statement also shows gross profit, i.e. net sales less cost of sales, of 14.5 billion in 2011. When an income statement shows a gross profit subtotal, it is said to use multi-step format. Their statement also shows R&D, which basically stands for research and development, advertising, and SG&A expense as three separate line items. Okay. The income statement also shows operating profit, which is net sales less cost of sales and all other operating expenses, of 3.3 billion in 2011. L'Oreal defines operating profit in accordance with local regulations as stated in their footnotes. So operating profit consists of gross profit less research and development expense, advertising and promotion expense, and selling, general and administrative expenses. Another thing to note is that L'Oreal's 3,196.3 million operation profit deducts 96.3 million of other income and expenses, which according to the footnotes of the income statement or the financial report, it includes items such as capital gains and losses on disposals of property, plant and equipment, and intangible assets, impairment of assets, and restructuring costs. Below operational profit, L'Oreal shows finance costs, finance income, and net finance costs amounts for 2011. It's about 48.1 million, 28.5 million, and 19.6 million respectively. After deducting finance costs, L'Oreal income statement shows 5.6 million in other financial expenses and 295.6 million in dividends from its investment in another company. It's called Sanofi SA. It's basically a French healthcare company. This arrives at a pre-tax profit or profit before tax and non-controlling interest of 3,466.7 million in 2011. After income taxes, L'Oreal 2011 net profits, i.e. net income, is 2,440.9 million. As noted, where applicable, companies present another item below net income, information about how much of that net income is attributable to the company itself and how much of that income is attributable to minority interests or non-controlling interests. So this is represented in front of you by the EPS line item. The third and last example of an income statement format we're looking at is for Procter & Gamble, P&G, they're usually called in short. This is their income statement for the similar time span, 2011. Okay, and as you can notice here, it is an American company, and their income statement is denominated in millions of US dollars. Note that the year end is 30th of June. Okay. The top line of P&G's income statement shows net sales. Procter & Gamble's income statement does not show gross profit. It is an example of the single step format we talked about earlier. P&G income statement shows operating income of 15,818 million in 2011. Below operating profit, P&G shows interest expense and then other non-operating income or expense to arrive at pre-tax earnings of 15 billion and 189 million in 2011. This amount is labeled earnings from the continuing operations before income taxes, because in 2010 and 2009 P&G had some amounts of income related to discontinued operations. In the footnotes, the company discloses that it completed the divestiture of its global pharmaceuticals business to Warner Chilcott PLC in October 2009, and the divestiture of its Folgers coffee business in November 2008. So these are pretty much a discontinued projects that P&G was working on. After income taxes, P&G's 2011 net earnings, i.e. the net income, is 11,797 million. P&G does not have any minority interest, so that's why it's not covered in this income statement, unlike the previous two examples we looked at. And finally, the income statement also shows EPS or earnings per share, both basic and diluted. Okay, and as I said, this is a topic that we're going to cover only briefly in following or in coming slides. Now we will look at some accounting issues that relate to income statements. And since the revenue is the top line in an income statement, so we will begin our discussion of line items in the income statement with the revenue recognition process. An important aspect concerning revenue recognition is that it can occur independently of cash movements. Okay, A fundamental principle of accrual accounting is that revenue is recognized or basically reported on the income statement when it is earned. So the company's financial records reflect revenue from the sale when the risk and reward of ownership is transferred. This is often when the company delivers the goods or services to their customers. If the sale was on credit, revenue is recognized and a related asset such as trade or accounts receivable is created. Later, when cash changes hands, the company's financial records simply reflect that cash has been received to settle an account receivable, just like you have learned in your previous accounting courses. If a company receives cash in advance and actually delivers the product or service later, the company would record the liability for unearned revenue when the cash is initially received. Later, as products and services are delivered, revenue would be recognized as being earned over time. An example would be a subscription payment received for a publication that is to be delivered periodically over time. Now let us dive down deeper in this matter. So we'll try and answer the first main question, is when to recognize revenue. Okay, so when do we actually report revenue on the income statement? Because this is a critical issue in accounting. Based on the IFRS, the standard specifies that revenue from the sale of goods is to be recognized or basically reported on the income statement when the following conditions are satisfied. The entity has transferred to the buyer the significant risks and rewards of ownership of the goods. The entity retains neither continuing managerial involvement to the degree usually associated with ownership nor effective control over the goods sold. The amount of revenue can be measured reliably. It is probable that the economic benefits associated with the transaction will follow or flow to the entity. And finally, the costs incurred or to be incurred with respect to the transaction can be measured reliably. Simply put, revenue is recognized when the seller no longer bears risks with respect to the goods. For example, if the goods were destroyed by fire, it would be a loss to the purchaser. Okay? The seller cannot tell the purchaser what to do with the goods. The seller knows what it expects to collect and is reasonably certain of collection, and the seller knows how much the goods actually cost. IFRS note that the transfer of the risks and rewards of ownership normally occurs when goods are delivered to the buyer or when legal title to the goods transfers. However, as noted by the above, remaining conditions, physical transfer of goods, will not always result in the recognition of revenue. For example, if goods are delivered to a retail store to be sold on consignment and title is not transferred, the revenue would not yet be recognized. And finally, IFRS specifies similar criteria for recognizing revenue for the rendering of services. The same thing that applies to the sale of goods. On the other hand, when we look at the United States generally accepted accounting principles gap, we see that the principle specifies that revenue should be recognized when it is realized or realizable and earned. So the US Securities Exchange Commission, motivated in part because of the frequency with which overstating revenue occurs in connection with fraud and or mistreatment, provides guidance on how to apply the accounting principles. This guidance lists 4 criteria to determine when revenue is realized or realizable and earned. The first one is there should be an evidence of an arrangement between the buyer and seller. For instance, this would disallow the practice of recognizing revenue in a period by delivering the product just before the end of the end of the accounting period, and then completing a sales contract after the period end. The second criteria is that the product has been delivered or the service has been rendered. For instance, this would preclude revenue recognition when the product has been shipped, but the risks and rewards of ownership have not actually passed to the buyer yet. And the third criteria is that the price is determined or determinable. For instance, this would preclude a company from recognizing revenue that is based on some contingency. And finally, the last criteria is that the seller is reasonably sure of collecting money. For instance, this would preclude a company from recognizing revenue when the customer is unlikely to pay. Okay? Now let's move on to expense recognition. Under the IFRS standard, the term expense is defined as the decreases in economic benefits during the accounting period in the form of outflows or depletions of assets or incurrences of liabilities that result in decreases in equity. Other than those relating to distributions to equity participants. Okay, so from this we can see that expenses encompasses losses as well as those expenses that arise in the course of the ordinary activities of the enterprise. Okay. Under the United States generally accepted accounting principles, however, expenses are in this case defined as outflows or other using up of assets or incurrences of liabilities, or a combination of both, from delivering or producing goods, rendering services, or carrying out other activities that constitute the entity's ongoing major or central operations. Okay? So the expenses here differ from losses, defined as a decreases in equity or net assets from peripheral or incidental transactions of an entity, and from all other transactions and other events and circumstances affecting the entity, except those that result from expenses or distributions to the owners. Okay? Similar to the issue with revenue recognition, in a simple hypothetical scenario, expense recognition would not be an issue. For instance, assume a company purchased inventory for cash and sold the entire inventory in the same period. When the company paid for the inventory, absent indications to the contrary, it is clear that the inventory cost has been incurred, and when that inventory is sold, it should be recognized as an expense. Okay, so in this case, cost of goods sold. Alright, and it should be reflected in the financial records accordingly. Assume also that the company paid all operating and administrative expenses in cash within each accounting period. In such simple hypothetical scenario, no issues of expense recognition would arise. In practice, however, as with revenue recognition, determining when expense should be recognized can be somewhat more complex. In general, a company recognizes expenses in the period that it consumes, i.e., uses up the economic benefits associated with the expenditure or losses some previously recognized economic benefits. Okay, a general principle of expense recognition is the matching principle. Okay, you might have came across this term before, which basically, strictly speaking, under the IFRS do not refer to a matching principle, but rather to a matching concept, or to a process resulting in matching of costs with revenues. The distinction is relevant in certain standard setting deliberations, but under matching, a company recognizes some expenses, e.g., cost of goods sold, when associated revenues are recognized, and thus expenses and revenues are matched. Associated revenues and expenses are those that result directly and jointly from the same transactions or events. Unlike the simple scenario in which a company purchases inventory and sells all of the inventory within the same accounting period, in practice it is more likely that some of the current period sales are made from inventory purchased in a previous period or a previous periods. Okay, so it is also likely that some of the inventory purchased in the current period will remain unsold at the end of the current period, and so will be sold in the following period or following periods. Okay, so matching in this case requires that a company recognizes cost of goods sold in the same period as the revenues from the sale of the goods. Okay, so this is really important. So the company needs to recognize the cost of goods sold in the same period as revenues from the sale of the goods. Okay, period costs, expenditures, which basically means expenditures that less directly match revenues, are reflected in the period when a company makes the expenditure or incurs the liability to pay, such as administrative expenses, as an example. Okay, so these administrative expenses are considered a period cost, so they relate to a specific period. Other expenditures create assets that will result in future benefits over a number of accounting periods. For example, buildings, equipment, prepaid, and in this case, the expenditures are allocated systematically with the passage of time. An example of this would be depreciation expense that you've learned about in accounting. Now, it is important to understand that the process of recognizing revenues and expenses are mainly an accountant's job. The reason we are looking into that as analysts is for us to create a better understanding of these procedures, to help us better read the financial statements of different corporations using different processes of recognition. Okay? So for the analyst, understanding those regulations or procedures makes their job easier of understanding the actual position of a company. Okay? And for you trying to assess a company's future earnings, you need to also understand and differentiate between what we call a non-recurring items and changes in the accounting standards over an extended period of time. To assess a company's future earnings, for example, and also to evaluate a current period's earnings, it is helpful to separate those prior year items of income and expense that are likely to continue in the future from those items that are less likely to continue. Some items from prior years are clearly not expected to continue in the future periods and are separately disclosed on a company's income statement. Discontinued operations, to begin with, are when a company disposes of or establishes a plan to dispose of one of its components, or one of its component operations, and will have no further involvement in the operation. The income statement reports separately the effect of this disposal as a discontinued operation under both IFRS and GAAP. Financial standards provide various criteria for reporting the effect separately, which are generally that the discontinued component must be separable both physically and operationally. And because the discontinued operations will no longer provide earnings, in this case cash flow, to the company, an analyst can eliminate discontinued operations in formulating expectations about a company's future financial performance. The second aspect is what is called extraordinary items. This category is not permitted under IFRS and must be reported separately from continuing operations under US GAAP. Under the GAAP, an extraordinary item is one that is both unusual in nature and infrequent in occurrence. Extraordinary items are presented separately on the income statement and allow a reader of the statements to see that these items are not part of a company's operating activities and are not expected to occur on an ongoing basis. Extraordinary items are shown net of tax and appear on the income statement below discontinued operations. Given the requirements for classification of an item as extraordinary, unusual, or infrequent, an analyst can generally eliminate extraordinary items from expectations about a company's future financial performance. For other items on a company's income statement, such as unusual items, accounting changes, and non-operating income, the likelihood of them continuing in the future is somewhat less clear and requires the analyst to make some judgments. Unusual or infrequent items under IFRS require that items of income or expense that are material and or relevant to the understanding of the entity's financial performance should be disclosed separately. Unusual or infrequent items are likely to meet these criteria. Under GAAP, which allows items to be shown as extraordinary, items that are unusual or infrequent but not both cannot be shown as extraordinary. Items that are usual or infrequent are shown as part of a company's continuing operations. For example, restructuring changes or charges such as costs to close plants and employee termination costs are considered part of a company's ordinary activities. As another example, gains and losses arising when a company sells an asset or part of a business for more or less than its carrying value are also disclosed separately on the income statement. Highlighting the unusual or infrequent nature of these items assists the analyst in judging the likelihood that such items will reoccur or not. And finally, changes in accounting standards. When we talk about changes in accounting standards, we need to consider a few points. At times, standard setters issue new standards that require companies to change accounting policies. Companies may be permitted to adopt the standards prospectively, that means in the future, or retrospectively, restating financial statements as though the standard existed in the past. In other cases, changes in accounting policies from one acceptable inventory costing method to another, for example, are made for other reasons, such as providing a better reflection of the company's performance. Changes in accounting policies are reported through retrospective application unless it is impractical to do so. Retrospective application means that the financial statements for all fiscal years shown in a company's financial report are presented as if the newly adopted accounting principle had been used throughout the entire period, meaning in the past. Companies sometimes make changes in accounting estimates, such as the useful life of a depreciable asset. These changes in accounting estimates are handled prospectively, with the change affecting the financial statements for the period of change and future periods. No adjustments are made to prior statements, and the adjustment is not shown on the face of the income statement. Significant changes should be disclosed also in the notes of the financial reports. Another possible adjustment is a correction of an error for a prior period. For example, in financial statements is issued for an earlier year, and in this case, this cannot be handled by simply adjusting the current period income statement. Correction of an error for a period or a prior period is handled by restating the financial statements, including the balance sheet, statement of owner's equity, and cash flow statement for the prior periods presented in the current financial statements. Note, disclosures are required regarding the error. These disclosures should be examined carefully because they may reveal weakness in the company's accounting systems and financial controls. Here we'll just talk briefly about earnings per share. Okay, you're gonna see in your textbook you have a a detailed section about earnings per share, but for me, what really matters is just understanding what earnings per share is. Okay, one metric of particular importance to an equity investor, it is called EPS for short, which is earnings per share. EPS is an input into ratios such as the price to earnings ratio, or most commonly known as the PE ratio. Additionally, each shareholder in a company owns a different number of shares, so knowing the earnings per share figure and the price to earnings figure is really, really important to an analyst. IFRS requires the presentation of earnings per share on the face of the income statement for net profit or loss and profit or loss income from continuing operations. Similar presentation is also required under the United States GAAP. Okay. In your book, you will see a complete section outlining the calculations of EPS and explaining how the calculation differs for a simple versus complex capital structure. We're not really going to worry much about that in this stage. I just need you to understand what is earnings per share as a metric. Knowing everything that we've covered so far, we could now move on to the last and most important learning outcome of chapter 4, which is the analysis of the income statement. Okay, so before we dive into methods for analyzing income statements, we need to first understand common size analysis of income statements, meaning that we need to kind of shape our statement in a way that makes it easier to compare to other companies or to compare performance to previous years, regardless of the differences in size between these compared items. Okay, so the common size income statement show each line item on the income statement as a percentage of the revenue. Okay, common size statements also facilitate comparison across time periods, which we basically call time series analysis, and also across companies, which is a cross-sectional analysis, because the standardization of each line item removes the effect of size and the differences in size between the compared items. This format can be distinguished as vertical common size analysis. As the chapter on financial statement analysis discusses, there is another type of common size analysis known as horizontal common size analysis that states items in relation to a selected base year value. Okay, the discussion pertains to vertical common size analysis right here. So for that, we have an example that is presented right here of a partial income statement for 3 hypothetical companies operating in the same sector or the same industry. Company A and Company B, each with 10 million in sales, are larger as measured by sales than Company C, which has only 2 million in sales. In addition, companies A and B both have higher operating profits, so 2 million and 1.5 million respectively, compared with Company C's operating profits of only 400,000. So, knowing that, how can we as analysts meaningfully compare the performance of these companies, considering that they have different size, different sales, different operating profits, and so on. Here comes the role of using or employing common size income statements. We're going to see how we can treat that in the following slide, so let's move on to that. So as you can see here, common size statements facilitate comparison. So you could observe that for example, compared with Company A, Company C's expenses and profit as a percentage of its sales are identical, regardless of the differences in size between the two. And compared with company B, although company C's operating profit is lower than company B's in absolute dollars amount, it is higher in percentage terms. 20% for company C compared with only 15% for company B. For each $100 of sales, company C generates $5 more operating profit than company B. In other words, company C is relatively more profitable than company B based on this measure. The common size income statement also highlights differences in companies' strategies. So comparing the two larger companies, A and B, company A reports significantly higher gross profit as a percentage of sale than does company B. We have 70% for company A and 25% only for company B. Given that both companies operate in the same industry, why can company A generate so much higher gross profit? One possible explanation is found by comparing the operating expenses of the two companies. Company A spent significantly more on R&D, research and development, and on advertising than company B. Expenditures on R&D likely result in products with superior technology, so expenditures on advertising likely also result in greater brand awareness. So based on these differences, it is likely that company A is selling technology superior products with a better brand image. And company B may be selling its products more cheaply with a lower gross profit as a percentage of sale, but saving money by not investing in R&D or advertising. In practice, differences across companies are more subtle, but the concept is similar. Okay, so I hope you can see that from this hypothetical example. So as an analyst, you need to note significant differences and or how you can do more research to try your best to understand the underlying reasons for the differences and their implications or effects for the future performance of the company in order to carry out a complete and deep analysis of company performances. Another very important tool that an analyst can use to analyze financial statements is the use of income statement ratios. An important aspect of financial performance is profitability, and one indicator of profitability is net profit margin, also known as profit margin and return on sales, which is calculated as net income divided by revenue or sales. In the definition of margin ratios of this type, sales is often used interchangeably with revenue. Return on sales has also been used to refer to a class of profitability ratios having revenue in the denominator. So we have net profit margin, which basically equals net income divided by revenue. We have net profit margin, or to understand net profit margin a little bit closer, net profit margin measures the amount of income that a company was able to generate for each dollar of revenue. So the higher level of net profit margin indicates higher profitability and is thus more desirable. Net profit margin can also be found directly on the common size income statements, so it can make your job as an analyst easier. Another measure of profitability is the gross profit margin. Gross profit margin is calculated, or sometimes called gross margin for short, is calculated as revenue minus cost of goods sold, and the gross profit margin is calculated as the gross profit divided by revenue. Okay, so your formula would be gross profit margin equals gross profit divided by revenue. The gross profit margin measures the amount of gross profit that a company generated for each dollar of revenue. And of course, a higher level of gross profit margin indicates higher profitability and thus is generally more desirable. Although differences in gross profit margin across companies reflect differences in company strategies. For example, consider a company pursuing a strategy of selling a differentiated product, e.g. product differentiated based on brand name, quality, superior technology, or patent protection, the company would likely be able to sell the differentiated product at a higher price than a similar but undifferentiated product, and therefore would likely show a higher gross profit margin than a company selling an undifferentiated product. Although a company selling a differentiated product would likely show a higher gross profit margin, this may take time. In the initial stage of the strategy, the company would likely incur costs to create a differentiated product, such as advertising or research and development, which would not be reflected in the gross margin calculation. A stylized illustration of this point was provided in the previous example we looked at, in which company A and also C had a much higher gross profit margin than company B, accompanied by high R&D and advertising expenses. The net profit margin and gross profit margin are just two of the many subtotals that can be generated from common size income statements. Other margins used by analysts include the operating profit margin and the pre-tax margin, and these margins are ratios. Okay, so one number shown in terms of another that indicates profitability. They can all be found directly on the common size income statement. Now, this slide first reviews a few key relationships presented in earlier chapters in your textbook. It then lists 4 items included in other comprehensive income. Total beginning equity plus changes equals total ending equity. Total comprehensive income equals net income plus other comprehensive income. Now, to understand comprehensive income a little bit more, we need to note that comprehensive income includes both net income and other revenue and expense items that are excluded from the net income calculation. Other comprehensive income are items that bypass the income statement, and under the IFRS, total comprehensive income is defined as the change in equity during a period resulting from transaction and other events other than those changes resulting from transactions with owners in their capacity as owners. Under the United States GAAP, on the other hand, comprehensive income is defined as the change in equity of a business enterprise during a period from transactions and other events and circumstances from non-owner sources. So it includes all changes in equity during a period except those resulting from investments by owners and distributions to the owners. Now, we also need to understand that there are 4 types of items that are treated as other comprehensive income under both IFRS and GAAP. So the specific treatment of some of these items differ between the 2 sets of standards, but these types of items are common to both. The first type is foreign currency translation adjustments, which in consolidating the financial statements of foreign subsidiaries, the effects of translating the subsidiaries' balance sheet assets and liabilities at current exchange rates are included as other comprehensive income. The second type is the unrealized gains or losses on derivatives contracts accounted for as hedges. So changes in the fair value of derivatives are recorded each period, but these changes in value of certain derivatives are treated as other comprehensive income and thus bypass the income statement as well. The third type is unrealized holding gains and losses on a certain category of investment securities, namely securities available for sale, for example. Fourth and last type is certain costs of a company's defined benefit post-retirement plans that are not recognized in the current period. To understand this a little bit more, we look at an example of comprehensive income here. This example illustrates the relationship between the change in total equity and comprehensive income, and also the relationship between net income other comprehensive income, and comprehensive income. So the question says assume the following about a company. They have a beginning shareholders equity of 200 million euros, net income for the year of 20 million, cash dividends for the year of 3 million euros, no issuance or repurchase of common stock was carried out during the financial period we're looking at. And finally, the actual ending shareholders equity is 227 million. Okay? So what is required from you here is to figure out what is or what amount has bypassed the net income calculation by being classified as other comprehensive income. So that's the first thing. The second thing, what is the company's comprehensive income in this case? So let's try to solve this question together, and we'll see how we can do that in the following slide. So to answer the first part, what amount has bypassed the net income calculation by being classified as other comprehensive income? The answer here, or to figure out the answer here, we need to first look at the total change in equity. Okay, we find this from the difference between the beginning shareholders equity, which was 200 million, and the actual ending shareholders equity, which was 227 million. So the difference in this case is 27 million. Then we look at the change in common stock, which was 0, okay, because we were told in the question that there was no issuance or repurchase of any common stocks during the period. Third thing we need to figure out is the change in retained earnings. It was 17 million euros in this case. We calculated that based on having a net income of 20 million minus the dividends that was distributed to the investors of 3 million. So 20 million minus 3 million, that would give us the 17 million. Thus the change in accumulated other comprehensive income, that is the amount of other comprehensive income for the year, was 10 million, and that is calculated by the 27 million total change in equity minus change in retained earnings of 17 million. Okay, so 27 million minus 17 million, that will give us the 10 million, which is our answer for the first part. Now the second part, what is the company's total comprehensive income? This total comprehensive income we know from the formula that would equal the net income plus other comprehensive income. So net income is given as 20 million from the question itself, if you notice on the third line. And then the first part of the question, or from the first part of the question, we calculated other comprehensive income of 10 million. So that would give us our 20 million from the question plus the 10 million we calculated in the first part. 20 plus 10 million, that would equal 30 million. So that is it for chapter 4, the income statement. We took a closer look at the income statement and looked at how much revenue the company generated during a period and what costs it incurred. So these are the two main things that an income statement reflects. We also considered some accounting issues, primarily relating to the timing of revenues and expenses. So revenue recognition and expense recognition, in addition to looking at some non-reoccurring items that might be available in some income statements and how we can distinguish those and take them into consideration in our analysis. After that, we looked briefly at the earnings per share. We just looked at the definition and the formula for earnings per share, okay, but we ignored the remaining special cases and special considerations that relate to the analysis of earnings per share, because that is outside the scope of this course. Following that, we looked at the tools for income statement analysis, including common size analysis and profitability ratios, mainly two profitability ratios that we covered. And finally, we looked at comprehensive income, that includes the net income and other comprehensive incomes, and we looked at how we can calculate those through the example that we've covered. I hope that you enjoyed today's class, and now I look forward to answering any questions that you guys might have. And after that, we'll just thank you for participating and attending this lecture, and I wish you the best of luck. Take care.